Investment advisory services are offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor. This is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Any mentions of rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing company, not guaranteed by any bank or the FDIC. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean that the advisor has achieved a specific level of skill or ability. A Roth conversion may not be suitable for your situation. The primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. The information provided is to help you determine whether or not a Roth IRA conversion may be appropriate for your particular circumstances. Please review your retirement savings, tax, and legacy planning strategies with your legal or tax advisor to be sure a Roth IRA conversion fits into your planning strategies. No legal or tax advice is provided. Always consult with a tax professional. All rights reserved.
When it comes to financial literacy, social media has done a lot of damage. We're exposing some of the worst financial planning advice to go viral on social media, exploring why it's so dangerous, and doing a bit of financial influencer myth-busting to perfect the record on today's show. Stay tuned.
And now, how to retire with Fuchs Financial.
The main thing for the majority of the listeners out there who are approaching retirement is I don't want to be surprised.
Helping you build, preserve, and manage your wealth.
You got Roth IRAs, you got individual accounts, and finding the right taxable strategy, that's going to be huge for you.
Welcome to How to Retire with Ben Fuchs.
What is social media's effect on your financial future? That's what we're going to get into today, particularly TikTok. And Ben Fuchs is with us. First of all, are you on TikTok, Ben, before I do anything else?
I have deleted TikTok. Now, to be fair, I have also deleted TikTok maybe 5 or 6 times from my phone. I have certain family members, maybe my wife, who may spend some time on it. I don't want to call anybody out.
Of course not.
But I have heard of this TikTok phenomenon.
Yes, I have too. Now, I do not have it. I have Facebook, Instagram, and Twitter, and that's just enough for me. But I want to welcome everybody into the show. This is How to Retire with Ben Fuchs. I'm your consumer advocate, Gary Nolan. And Ben is here to help you take charge of your money. Ben is a certified financial planner, certified private wealth advisor professional, and fiduciary with over 20 years experience. And of course, he is with Fuchs Financial. Before we get started, I want to remind everybody, get the How to Retire Blueprint. It's a comprehensive plan. There's no cost or no obligation. We'll be talking about that throughout the show. Here's that phone number, 800-380-8985, 800-380-8985. So let's dive in. Okay, so bad financial advice is more common than ever before thanks to social media, with totally unqualified amateurs giving everyone who wants to be an influencer. Now, especially on social media, the personal finance hashtag on TikTok alone has amassed 10.7 billion views. And after hearing a few of the pieces of financial advice gone viral, this might be a clear picture of why Congress is thinking about banning the app, among other things, too. Let's talk about this for a little bit, Ben.
Yeah, okay. So according to Wall Street Zen, 76% of Gen Zers scroll through TikTok or YouTube to get financial advice. A study performed by Paxful found that about 1 in 7 videos from TikTok's financial influencers tends to be misleading users. They also found that more than half, 52% of the influencer accounts they'd analyzed posted at least one misleading video. The audience that the sample size reaches, a collective 9.46 million followers.
Wow.
So hashtag FinTok has more than 4.5 billion views on TikTok alone. Of course, it does include a reminder when you search for the term, imploring searchers to do their own research.
So I'm going to explore some of the top financial planning advice that's gone viral on social media and explore how much this is inaccurate. It could be catastrophic and dangerous to your financial future. I'm going to start here with this one. They say take this 401k and shove it. So people are objecting to the 401k. Ben, let me play this clip for you. A few creators discussing the 401k on TikTok. I'll get your comments on the other side.
401k is the biggest scam in America.
401ks are a scam.
401ks are the worst investment.
Screw the 401k.
The most idiots out there. They go, I have a 401k. Well, you've been sold a bill of goods, sweetheart.
401ks are just there to keep people at work, not great financial freedom.
I don't know about all that, Ben. What do you think?
Man,
I know.
it makes me crazy. So there are so many people that are saying, hey, don't put money in the 401k, put your money into real estate, put your money into life insurance, put your money into all these other things. Okay, well, look, man, let's look at the actual history of those other investments that you're recommending, and let's see how they have panned out. As somebody who got very into real estate in my early 20s, because I read a book that was very popular. I don't want to name any names because I don't want a lawsuit, but it's a very, very popular book. And it talked about reinvesting all of your money back into real estate and leveraging yourself as much as you can to buy as much real estate as you possibly can. And I did that. And that was that was about 2006 when I had, I would say, about $1.5 million in total value in real estate back then. And I don't know if you remember a little thing called the Great Recession.
Yeah, I think I remember. I think that occurred around 2008.
But when you have over $1 million in mortgages to get that $1.5 million in real estate, all of a sudden the bottom falls out. And so the benefit of the 401k and the benefit of these 401ks is that you are consistently, slowly building wealth. This whole concept that people have of just like magically having wealth appear, it makes me crazy. Any kind of get rich quick anything is so overblown. The whole idea of a 401k is that you're consistently, predictably building up your savings. And if you look at the S&P 500, from 2008. Again, at its height, it was around 1,300 in 2008, and at its bottom, it was around 800. It had a significant drop in the ballpark. But you look at that today, and if you held on, even if you bought at the absolute height in 2008 of the S&P 500 in your 401k, it's way more than tripled. It's actually almost quadrupled as of today. So if you had $1 million in your S&P 500 401k in 2008, and then it dropped to 620,000, and you left it there, it would be around $5 million today.
Oh boy! Wow.
And if you put that into a Roth 401k, the biggest scam in the world, whatever they want to say, that $5 million would be tax-free. So I think that we have a problem when we get all this advice and all these, and don't get me wrong, I have my friends that send me these, say, hey, Ben, what do you think about this? I'm like, that guy's an idiot. Don't talk to him. That's pretty much how it goes.
So you do have people coming to you with get rich quick schemes, and you kind of shut that down when they come to you? Pretty much.
Man, yes. Every time. I hate them. I despise them. You got some guy standing in front of a 300-foot yacht that's not even his. I remember there was a 19-year-old social media influencer that took a picture of him outside this house saying, believe in your dreams, and it wasn't his house. There's so many scams out there, so many people pretending to have all the answers, and they just don't.
Yeah. Don't do it. The show is How to Retire with Ben Fuchs. I'm Gary Nolan, your consumer advocate. I want you to get on Ben's calendar, claim a spot right now. No cost or no obligation to get that How to Retire blueprint. 800-380-8985. 800-380-8985. So let's dig in a little bit more, Ben. So why following this advice? How can that be? That can be very dangerous, obviously, right?
Yeah, failing to contribute to your retirement or utilizing an investment vehicle that you know nothing about can be catastrophic to your financial future. 401ks are simple and effective and yield results. I help people retire every single day. We see people relying on their 401ks in lots of different ways to generate the income that they need to have in retirement. That's what's really important. You want to talk about figuring out how to retire, the 401k helps you get there. Most people say, I don't know how to do that. I just put a whole bunch of money in and hope that it's there when they come out. That's when they call us so we can help them retire. But that's the whole concept.
Yeah, it really is. And that's obviously it's worked well for a long time. And there's some bad influences on social media, and you really have to be careful. One of the other things that we talk about is the invest in the rich and famous to get rich and famous. I guess copycatting some other folks that maybe have done well for themselves. Yeah,
this is my least favorite thing, because not only do they do this, but you see financial advisors. Not financial advisors. You see, how do I say it? Mainstream media financial personalities. That's what they'll call them, financial personalities. Talk about, this is what you do and you should. And I don't like them either. So let's be fair. But what you find is that if I am a financial advisor and I'm managing millions or billions of dollars or whatever it is, I want people to know exactly what I bought so that they can buy it too. Why? Great question, Gary. Thank you so much for asking.
I was about to ask, yeah.
Because when a whole bunch of people buy the thing that I just bought, it drives up the price. Why do you think that, you have these people saying, oh, follow these congressmen and senators, buy what they buy? If I'm a congressman or senator and somebody buys something, a whole bunch of people buy it right after I do, that means that it's driving up the cost of what I just paid for. So I already own it. I'm not telling you to buy it before I buy it. You're buying it after I bought it. And that means that you're going to pay a much higher price for it than I did, and I am going to reap those gains.
What was there was a while back, I can't remember the company that they drove the sales up, the stock up. Was it like Played Against Sports or something like that? Remember that?
It was it's a game store in the mall, and I can't, my mind is drawing a blank right now.
Me too. But they way overvalued that stock, didn't they?
Way overvalued. And, the people that got in first made their money, and the people that got in last gave their money to the people who made their money. That's kind of how, in some ways, that is somewhat of a Ponzi scheme. So, it's tough. It's part of the problem. There's not a lot of accountability on TikTok. And so for me, if I give bad advice, I'm getting a call from the SEC. They're evaluating whether or not I should be able to maintain my license as an advisor. If you're some influencer on TikTok and you give bad advice, that's too bad.
Shame on you. Yeah, right. Exactly. Yeah. So, I guess, when it comes to your financial future, it stands to reason to have somebody like you in their corner, Ben, that has all the licensing and that you're an independent fiduciary. Am I right?
Yeah, look, if I could help somebody get quick by just selling life insurance, don't get me wrong, we get commissions for selling life insurance. Wonderful. If I could get rich quick by helping somebody just buy real estate, great, I would help them do that. But the reality is that the whole concept of owning real estate and really investing the right way in real estate is to buy a home that you can cash flow on, or at least break even on, and maintain, and then have them pay the mortgage over time, over 15 or 30 years, depending on how you set that up. Then you own the home free and clear, and it's gotten, the benefit of inflation over that time period. That's the beauty of investing in real estate. That's when it makes sense. You're not just trying to flip homes very quickly, and especially in this market, it's very, very difficult to try and attempt something like that. Or the benefit of flipping a home is that you're actually adding value to the home itself. But again, in an overbought market, that's difficult. Look, my job is to take people who have been good savers and help them worry less about retirement. Right? There's so many things to concern yourself with health and family and life and goals and how you're going to fill your time and what things you're going to be fulfilled with when you retire, that you don't want money to be part of that picture. We create the How to Retire Blueprint so that we can have our clients not worry about money in retirement. Let that be our job. Let us create a paycheck for you from your investments in retirement. That way you don't have to worry about it. Look, we all know the market's going to crash again. We just don't know when that is. And we all know the market will probably be higher than it is today, 5 to 10 years from now. You need to have a balance. You need to be able to take some risk. You need to have an area for safety. And you need to create a paycheck for yourself. You need to do that tax efficiently. You need to do that and have the right estate plan. So we need to put all these things together, your income, your investments, your taxes, and your estate planning, and have that all be together, and that's how we create the retirement blueprint for you.
800-380-8985, 800-380-8985. Get the How to Retire Blueprint. Folks at Fuchs Financial are standing by, ready to get you on Ben's calendar. All right, we're going to take a short break. Be back with more of Ben and How to Retire in just a moment. What's up next, sir?
Coming up, we continue down the rabbit hole of bad financial planning advice gone viral on social media and separate retirement planning fact from retirement planning fiction.
He's letting the clock run out on his Social Security to age 70 for maximum benefits. And here comes the Roth conversion. He's locked in for income for life. He's got some outstanding coaching with that annuity plan. He's created his own pension as well, and it looks like he's going to go all the way.
Play your best retirement game. Call Ben Fuchs at Fuchs Financial, 800-380-8985, 800-380-8985.
Welcome back to the show. This is How to Retire with Ben Fuchs. I'm your consumer advocate, Gary Nolan, here to help us take charge of your money is Ben Fuchs. Ben is a certified financial planner, certified private wealth advisor professional, and fiduciary with over 20 years experience. And, of course, he is with Fuchs Financial. Ben has calmed down now, ranting on TikTok. And
there will be more, Gary. There will be more. Worry not.
There'll be more ranting on the show. We have more rants today than anything else based on the show notes today. So let's dig right back into it here. So we continue down the rabbit hole of bad financial planning advice gone viral on social media and separate retirement planning facts from retirement fiction. All right, so survey says greed is good. No, survey says debit is good. I was quoting another movie there. Debt is good. So we're going to pivot from TikTok to classic TV. Here's a clip from an influencer in his own right, Family Feud host Steve Harvey. He's hosting the game show, Ask a Question to a contestant who then gives unsolicited opinion about debt. Here it is.
Give me a milestone people achieve they can be proud of.
Well, one day, I would like to have no debt.
That's not going to happen. Debt is okay. OPM, other people's money, is how you get rich. You use other people's money, not yours. That's how you get rich.
There you go, Steve Harvey, ladies and gentlemen. What do you think about this?
Oh, man. Look, first of all, Steve Harvey didn't make his money using other people's money. He made it doing TV. I mean, what are we talking about here? And the rules are different for people with 8 zeros behind their bank account than they are for the average retiree. The average retiree wants to get rid of the concerns, get rid of the things that they have to pay for so that they don't have to worry as much. That's what makes sense. I mean, sure, I agree. I don't want to get rid of all debt. I don't want you to start paying extra payments on a mortgage that you have with 4% or less on the percentage rate. That doesn't make sense to me. Why would we pay extra money on 4% debt when we can get a 5% CD? But if I have a 30% credit card, yeah, I want to get rid of that as fast as humanly possible. So, yeah, not all that is bad debt. But, the problem that I have with these multi-millionaires giving advice to people that they don't interact with on a daily basis is that their frame of reference is gone.
Right.
Susie Orman once told the FIRE movement, it's the Financial Independence Retire Early movement, that they needed to have over $5 million, and even then it didn't necessarily make sense for them to retire early. Well, no offense, Susie, but their lifestyle is totally different from yours. They don't need to have $5 million to retire early. That's ridiculous. And, Steve Harvey, you can use debt in a different way. Look, the bottom line is that Donald Trump used to talk about using debt. The more debt you have, the more the bank needs you to stay afloat. I remember reading his book from 20-something years ago.
Sure, yeah.
But that doesn't apply to the average person. The average person defaults on their debt, and they just get their house taken away. So it's not the same thing, and we can't use their advice internally the same way because, we different numbers. So be very cautious. The same reason, Warren Buffett is a genius and a brilliant stock picker still is not a financial advisor serving retirees like we are at Fuchs Financial. He said have 90% of your money in the S&P 500, 10% in treasury bonds. That sounds great, but you don't generate income that way. And so, again, it's a different level of advice. It's a different game. It doesn't make sense to take advice even from some of these brilliant rich people who made their money doing other things.
Yeah, I mean, Steve Harvey doesn't go into the supermarket start worrying about the price of eggs. Am I right?
I mean, I remember hearing Steve Harvey talk about how he's only going to be spending $100 bills from now on, and he's just not going to take the change. So if he goes and buys a pack of gum for, $12 or whatever the cost of gum is now, $1, whatever, he's just not taking the change because he doesn't need to anymore. Okay, great, Steve. Now you're going to tell me about financial planning? I don't think so.
No, that sounds somewhat dangerous. Well, it's funny. You just mentioned the next topic we're going to talk about. Play with fire and get burned, and that is the financial free retirement early movement. Explain that a little bit more to our listeners, Ben.
Yeah, so the FIRE movement is the Financial Independence Retire Early movement, and it was among the more frequent and popular universal financial advice that created a polarizing community of I guess they call them fire starters on social media. And many TikTokers who stoked this fire would use a guise of no pain, no gain, or no risk reward in an attempt to get more on board with the mission behind the movement. The issue is that everyone's financial situation is different. While the advice from many FinTech influencers may be well intended, a few things are important to acknowledge here. First, it simply doesn't make financial sense for everyone to join this bandwagon on a whim. Second, it might not align with the personal or professional goals one has set for themselves. Third, the notion that you need to join the community to prove something is precisely why it burned out, leaving a bad taste in the mouths of many who watched from the sidelines. I think the concept from some of these FIRE movement people was very interesting to me. And it's similar to a lot of what Dave Ramsey people do, where they start to get rid of all the stuff that they don't need and really just focus on, minimal shelter, paying less for food, paying off all your debt, living basically free. And so as a concept, I don't have a problem with the FIRE movement. I think the way that they go about doing their initiations, the way that they do about creating their community is something that a lot of people take issue with. But the concepts are fine. Again, it just doesn't fit a lot of people. I spend a lot of money on daycare. Dave Ramsey made fun of somebody for having to pay a lot of money for daycare. I don't really have another option, man. I got 3 kids. My youngest is still, in daycare, and I pay a fair amount of money every month for that, but I need to do that so that I could work, so that my wife can work, then that just makes more sense for us, and I don't want anyone to tell me that what I'm doing is wrong because they disagree with it. I don't care what you think. I'm doing what's best for me.
Sure, absolutely. And that's what Ben does with you because of his fiduciary responsibilities. By law, have to have the best interest of his clients. So when you come see him, he's going to be honest with you. He's completely independent. And I want you to get the How to Retire Blueprint. That's a comprehensive plan that Ben and his team put together for you. No cost or no obligation. So what are you waiting for? Here's that phone number, 800-380-8985, 800-380-8985. The show is How to Retire with Ben Fuchs. I'm Gary Nolan, your consumer advocate. I want to thank you for joining us, spending part of your weekend with us. So I guess you pretty much answered the next question, which was how this advice can be dangerous. Ben, any more to add to that before we move on?
Yeah, I think there are a couple things. I think that there are high-risk investments that are required to make enough to retire in a decade or less wouldn't necessarily be aligned with the risk tolerance and capacity of the entire audience. And if you want to retire early, you should speak with a financial planning retirement specialist who knows how to do just that. You can certainly retire early without joining the FIRE movement. More than half of TikTok users turn to the platform for financial advice. Personal Capital study found that 41% of TikTok users use FactCheck, the advice they get through the app. 66% of FinTech users use the number of likes to determine whether a video was trustworthy. So again, we're taking our financial advice from a popularity contest, and that has never been a great decision.
All right, making the last one more troubling, and I realize this may sound like a joke because it's pretty outrageous, but it did go viral, over 2.6 million likes on TikTok. The Federal Reserve has a secret $1 million bank account for every American citizen. Here it is.
If you look at your Social Security card, you look at the back of the card, there's a letter on the back of your Social Security card. Mine's G. That correlates with a Federal Reserve Bank. Take that routing number for that bank, which is on the internet, and then your Social Security number is the account number, and you literally have an account in a Federal Reserve Bank attached to your name with millions of dollars in it. I've actually used the number and routing number to test it, see if it works. I've used it on energy, and the payment has gone through. So, yeah.
Yeah, I'm rich. What do you think of this?
That makes sense. Our government just likes to give away money. That sounds,
sure. Well, they do
sounds
that,
legit to me. I think there is a prince in... No. So look, multiple federal banks issued warnings to the public not to fall for this trick. And, quote, any video, text, email, phone call, flyer, or website that describes how to pay bills using a Federal Reserve Bank routing number or using an account at the Federal Reserve Bank is a scam, end quote. Federal Reserve routing numbers are intended for sorting and processing money between banks, not for making online payments. The New York Times reported that over 100,000 payments totaling more than $100 million were attempted because of the scam in a short 3-month period. So, look, why is this dangerous? It's the opposite of financial literacy spreading like wildfire shouldn't be celebrated. And while the format through which you obtain your news has changed, from obviously newspapers to Facebook and TikTok, it doesn't make it any less important to consult a professional before you go through your financial plan. Personal finance is personal, and it's imperative that you are considering the source and considering how the financial tip might actually harm you. So listen, We offer a How to Retire blueprint. If you are thinking about retiring, you can give us a call and sit down and have a free one-on-one consultation with one of our advisors. Usually that goes for about 60 minutes. Or you can keep on going to FinTalk. I don't care. But I do believe that we'll be able to help you a whole lot more than any app you happen to open. The only way that we can actually help you is if you give us a call so that we can sit down and go through your situation, find out what you need to retire, and figure out the ways and steps that it's going to take for you to get there. You can do it by phone, by Zoom, in person. Doesn't matter. We have offices in West Hartford, in Middletown, and Middlebury. We try to be accessible. There are 3 other advisors at the firm besides me, all with different designations from mine. We all work together as a team to create plans for our clients. But the most important thing, the biggest concern that most retirees have is, once I stop working, where am I going to get my paycheck? Well, surprise of all surprises, the biggest thing that we focus on for our clients is help them generate a consistent monthly paycheck without having to use an annuity or without having to reduce their principal. The goal is to maintain what you have, generate that income, and have a plan for retirement. Because we know the stock market will go down, we know the stock market will go up, and we need to live our life regardless. And a certain amount of risk is important, but we also need to make sure that you are taken care of.
All right, get the How to Retire blueprint. Ben just talked about it. 800-380-8985. What are you waiting for? 800-380-8985. Call right now. Still have a limited number. Availability is on our calendar this week. And remember, the consultation is offered at no cost or no obligation. It's a comprehensive plan. It's a complete plan. It is your individual plan. 800-380-8985. Call right now. Folks at Fuchs Financial are standing by, ready for your phone call. One more time before we go to break. 800-380-8985. All right, what's up next?
Failing to plan for what feels like a tiny piece of your financial planning puzzle now could wind up having catastrophic consequences later. We have you covered with the retirement planning questions you should be asking sooner rather than later. Stay tuned.
We believe in better. A better way to invest, a better way to serve you, and a better result. We can help you determine how much risk you're taking, red flags that could be potential problems for you, how much you are paying in fees or commissions, potential tax liability, or even how to address Social Security. Call Ben Fuchs at Fuchs Financial, proudly serving all of Connecticut. Call today, 800-380-8985. 800-380-8985.
Welcome back to the show. Going to put Ben on the hot seat here. We got lots of great questions for him, and I know he's ready. So the show is How to Retire with Ben Fuchs. I'm your consumer advocate, Gary Nolan, and Ben is back with us to help you take charge of your money. Ben is a certified financial planner, certified private wealth advisor, professional, and fiduciary with over 20 years of experience. I want to remind everybody, get the How to Retire blueprint in case you missed it at the end of the last segment before we took our break. It is 800-380-8985, 800-380-8985. It's a comprehensive plan. It's a complete plan. It's an independent plan. You deserve a more confident plan to retire. You want to be stress-free. You want peace of mind when you move into retirement. So here's that number again, 800-380-8985. So a good financial advisor will be able to answer these questions. A great financial advisor will make sure you're asking the right questions.
Gary, can I just say something real quick while we're talking about it? Because I feel like the name of the show is How to Retire with Fuchs Financial, but I feel like the name of the last 2 shows should be How Do I Get Ben Worked Up? Because I think that's because before that we went through the 4% rule, and I had to, I was ready to call my doctor for heart pressure medic. I don't take any, but I feel like maybe I need to. And then we start going through TikTok and celebrity advice, and I'm thinking I might go crazy.
Yeah.
But anyway.
So hopefully next show won't be like that.
I bet it will.
We have folks that help write the show notes that we present to Ben and the team here. And each week, the team goes through these segments and makes sure that it's well rounded and things that people want to know about. And but we I'm going to talk to them because your health is my concern. Okay,
I don't think it is, Gary. I don't think it is, but I'm enjoying this either way. I like this. And by the way, whenever he gives me these quotes I never hear them ahead of time. And it's always a live reaction. So let it be known. I want to keep that. But please,
that's
go
true.
ahead.
Yeah, because Ben and I talked before the show, and I go, "Do you want to hear the audio clips?" And he goes, "No, I just want to be able to respond to them." Generally hearing them for the first time. So that it is a lot of fun for me. I might add. Okay, so
I'm
anyway.
glad one of us is enjoying themselves, Gary. That makes me happy.
Absolutely. All right. So, and a great financial advisor may not even ask you questions that have not even considered, making sure that the right question is essential to your success along the road to retirement. So we're going to calm Ben down now because he has all the answers to these. So I'm gonna go through these, Ben, one at a time, and you can comment on them as you like. What do I need for retirement income?
Okay. So what we need for retirement income, the first thing that we need is to figure out how much you actually need. And I'll tell you, when I sit down with most people, when my other advisors sit down with most people, we find that what they think they need is wrong. Most people severely underestimate the amount of money that they're presently spending. It could be for a number of things. People have their budgets, but when I look at somebody's plan, and I know they bring home X amount of money, right? They got their 401k, they got their taxes and all their contributions. And I have a pretty good idea of what people bring home based on the salary that they tell me. And then you look at what people say they're spending, and there's usually some kind of a disconnect. Maybe people are spending way more than they think, and some people are spending almost nothing. But in most cases, people are wrong. And so the first thing that we do is help you figure out how much you're actually spending. And then once we've figured that out, then we need to figure out how much we need to generate from your investments, from your 401ks or IRAs or 403bs or 457s or through savings plans or whatever you have to generate enough income to be comfortable. And then we have to figure out how to do that in a predictable, consistent way. We don't want to have to sell off pieces of a mutual fund or a stock every month to generate your monthly income. I would consider that to be the wrong way to do it. Mm-hmm. The right way for me is to be able to maintain your principal and generate interest every month so you're not touching your principal when you need to make your monthly payments.
Right. Okay. So you got a client that comes in about 5 years out from retirement. What are you telling them and what they need to do, Ben, at that point?
Well, I mean, again, every client is different, and I'm not telling every client the same thing. But what we will do is take a look at everything that they have. We want you to bring in your tax return, bring in your financial statements. Let's take a look at what you've actually spent. And I don't care what you spent your money on. I just want to know the total that you've actually spent. So when we figure out those things, then we can say, all right, how much risk are you actually taking? How much fees are you paying in your accounts? Where do we need to make changes, if any? Sometimes you're in good shape and we'll tell you, but where do we need to make changes so that you can have the income that you need to generate in retirement, so that you can do the things that you want to do in retirement, so that everything is kind of segmented out? If you want to leave a lot of money behind to the next generation, are you in a position where you can do that if you retire in 5 years? And are you somebody that wants to spend a lot of money on traveling for the next 5 or 6 or 10 years in retirement? Again, let's take a look at that and figure out what you want to do. But the 5 years before retirement, the goal is to help you, figure out what you need to do and make sure that we can get it done.
Mm-hmm. The show is How to Retire. Great advice, Ben. How to Retire with Ben Fuchs. I'm Gary Nolan, your consumer advocate. I want you to get the How to Retire blueprint, 800-380-8985, 800-380-8985. We're holding Ben's feet to the fire here, answering a lot of questions for us. And in regard to your personal retirement, here's a big one that comes up a lot, Ben. How do I pay for medical expenses in retirement?
Yeah, this is really important. And it came up so much that we actually decided to do Medicare internally here at the office. So now we have 2 of our advisors that are able to do Medicare also, which is incredibly important. And we're working on hiring a separate person just for Medicare. But we want people to be able to understand what the options are. And for me, Medicare isn't something that we expect to make money on. It's something that we expect to be able to help our clients with and make sure that they're doing things correctly. When we look at these things, we say, all right, what's the worst case scenario? If you do, one plan versus another on Medicare, you do, one thing versus, there's so many different options and ways that you can go. You can have a spreadsheet with 50 columns and 60 rows and go through all of them. But that's really what we do. We're here to help our clients figure that out and navigate that. And when you need to retire before 65, before Medicare, and you don't have a plan from work where you're getting the health insurance, again, we want to help you look at options and understand how you work that into your retirement budget and what we need to do to generate the income to make sure that you can retire before that date and be comfortable.
Yeah, a lot of folks retire early and they have that gap between their retirement age and when Medicare kicks in, and that's where Ben will help you as well. He just mentioned that. So should I take a lump sum pension offer?
Maybe.
Yeah.
We'll look at this and we'll say, all right, what is a lump sum payout that you would get versus the amount of income that you would get in a year? And then we can just do a simple calculation. That income that you would get in a year, is it more than 8%? Right? Am I getting, so if I was going to get a $500,000 payout, am I getting more than $40,000 a year? That's 8% of $500,000. And if the answer is yes, then typically we want to take that income. We don't have a lot of things that can guarantee 8% a year in retirement. But if it's like 5 or 6%, then yeah, we'll take that out. There are investments that we can do that can generate 8% a year with some risk, don't get me wrong, but our expectation is that they will get you about 8% a year after our fee. And so we can do that and still maintain our principal. And then we have to counter that off with certain other investments. Do we have a safety net? But again, we want to look at what the actual rate of return you're getting if you take the income versus if you took the lump sum.
All right. So next question, we could spend a whole show on this, and we probably have. Should I buy an annuity? I think the answer is maybe, based on your situation. Am I right? You really can't answer this.
You don't even need me here, dude. You got this. Yeah, the answer is maybe. Yeah, I don't know. It depends. What are we trying to accomplish? The concern for me is that I've seen advisors out there that it doesn't matter what your situation is or what you have or what you need. It's not just, should I buy an annuity? There's only one annuity that I use, and this is the one for you. And that is a problem for me because there are certain annuities that will give bonuses, which, by the way, I tend to stay away from. I dislike them strongly. But if that's your cup of tea, so be it. But there are a lot of companies that offer these bonuses because they want to entice you to come in. And by the way, I don't know any insurance company that's just giving away money, but whatever, that's fine. I'll stay out of it. So in any case, you want to make sure that the annuity that you have actually fits you. There are annuities that will guarantee income in retirement like a pension. And there are annuities that will simply allow your money to grow safely so that you can take from them down the road without affecting your principal because you can build up interest inside that annuity and then just take the interest down the road as needed. So it all depends on what your goals are. And there are annuities that, that can kind of follow through each piece. And then there are some people that just absolutely don't need an annuity whatsoever. Our goal was to help you figure that out either way.
Mm-hmm. Yeah, I got Ben worked up again. Sorry about that, Ben.
Thank you, Gary.
All right, well, time for one more. And again, we could do a whole segment on this too. When should I claim Social Security? Let's wrap up the segment with that, Ben, real quickly.
So this is big. And people say, hey, it's a pretty simple decision. A lot of the stuff that they used to do, they've taken out. To which I reply, no, it's not. Social Security can be very complicated because it's not just the amount of income that you get, it's how much taxes are you paying on the Social Security that you get. If you're making $150,000 a year and you're 67 and you're past your full retirement age and you don't need that income, should you then take Social Security just because you don't know when you're going to die? Probably not. We'll talk about it. Also, are we looking at doing conversions to a Roth IRA in retirement? Are we looking to generate as much income as we can and pay as little taxes as possible on that income? Probably. And when and how much you get from Social Security plays a big role in that discussion. But again, when you come to our office, we have software that we use to look at your scenario, to look at what you do. If you retire at 62 versus 64 versus 68, how does that impact your money in retirement? But what is the actual impact? Do you run out of money if you retire at 62? How much do you have left after you hit 90, 95, 100? Does that matter to you? Some people will say, I don't care, I'm going to die at 87. Okay, well, congratulations on being able to pick the number, but, I can't help you there. We can figure out what you need. I think the goal for us is to be able to do scenario-based financial planning. Whatever you want to do, delay Social Security, taking Social Security early, we want to show you the impact of those decisions before you make them. And by doing that, we can keep you from making a lot of mistakes before and in retirement. But we can't do any of that unless you pick up the phone and give us a call.
All right. The first step, sit down with Ben and his team. Something we're talking about resonates with you. You feel need to get that second opinion. You want to make sure your plan is really aligned with your goals. Very important risk tolerance we talk about. Get your How to Retire blueprint. It's a comprehensive plan. It is an independent plan just for you. 800-380-8985. 800-380-8985. Folks at Fuchs Financial are standing by, ready to have you claim your spot on the calendar. 800-380-8985. Do it right now while you're thinking about it. The How to Retire Blueprint. All right, we'll take a short break. Be back with more of Ben and How to Retire in just a moment. What's up next?
Listeners have questions, and we've got answers. That and more coming up next.
Do you ever feel like you're fighting for financial knowledge? Don't let bad advice be a punch in the gut to your retirement. Take advantage of a complimentary, no-cost, no-obligation consultation with a local, trusted financial coach.
Call Ben Fuchs and the team at Fuchs Financial, 800-380-8985. That's 800-380-8985.
You've got questions. We've got answers. Well, I don't have the answers. Ben's the guy with the answers. I'm Gary Nolan, your consumer advocate. With me is Ben Fuchs. Ben is back to help you take charge of your money. Ben is a certified financial planner, certified private wealth advisor, professional, and fiduciary with over 20 years experience in the business. And I want you to get the How to Retire Blueprint. Here's that phone number, 800-380-8985, 800-380-8985. Folks at Fuchs Financial are standing by because you deserve a more confident plan to retire. You want to be stress-free. You want peace of mind when you move into retirement, maybe in the red zone we were talking about earlier. So now's the time to really start thinking about it, really hunker down and get that plan put together for you. No cost or no obligation. So again, what are you waiting for? 800-380-8985. All right, let's get to our questions that came into us from the phone. Gus in Goshen, is it relatively easy to roll over a 403B?
Yes, probably. So it is very easy to roll over a 403B after someone has retired. What happens? We set up an IRA. Our company uses Charles Schwab. We used to use TD Ameritrade. Charles Schwab bought TD Ameritrade. Now we use Charles Schwab. We like them. Those were the two companies that basically stopped charging fees for trading first. And they did that a lot. So they're able to operate pretty well without charging a tremendous amount of fees every time they do stuff. And so we like them. But we open up an IRA in your name. And then we call the 403B company together because nobody wants to do this on their own because, they might have questions that you don't understand, which is why we're here. So we call them with you to do the rollover with you and roll that money from the 403B into the IRA. Now, why do we do that? Great question, Gary.
Why do you do that, Ben?
Look, you got this, man. So we do that because there are so many more investment options available to you inside of an IRA than there are in a 403B. Even if you have a link to where you can pick individual stocks and other things, sometimes they call it a broker link, we move it to an IRA so that we have more accessible to us. And also, by the way, I don't want a lot of my clients picking their own individual stocks. I don't think that's a great recipe. Now, some of them have picked NVIDIA 2 or 3 years ago, and they're sitting pretty, and I'm proud of you. Great job. I had somebody come up to me the other day saying, Ben, I could do your job just by NVIDIA and walk away. I said, please don't do that. I'll be happy if it makes money, but it's a lot of risk. Anyway, so back to the 403B, back to why we do it, is that we can own individual stocks inside of the IRA, and in most cases, we cannot do that in the 403B. Additionally, we can do things like annuities if they're appropriate. We can do things like notes or individual bonds. All that can be done inside of an IRA, and those investments are more geared toward generating income. For most people, once you're over 59 and a half, you can do something that's called an in-service rollover.
Right, yeah.
Meaning that you can take the money out of that 403B and roll it into the IRA. Will that close your 403B? No. In service means that you're still working. So you can still contribute to that 403B. If they're giving you any kind of a match, you'll still continue to get it, like a 401k or a 457. All those same rules apply. But it just means that we're able to do something different with that money instead of leaving it where it was, probably in a target retirement date fund that has 2025 or 2030 after it. So we can roll that money over and invest it differently so that we can help you get returns that will be more protected in retirement.
Mm-hmm. And that is not a taxable event when you're rolling it over. Am I right, Ben?
You got it, Gary. So moving money from the 403B to an IRA or a 401k or a 457 to an IRA or through a savings plan is a non-taxable event. You do have to report it to the IRS because they want to know what happened to this money, but that's not a big deal. You don't pay taxes on that money to roll it over. You only pay taxes when you take it out of the IRA and move it into your bank account.
There you go. The How to Retire Blueprint. You need it. Let's get it. 800-380-8985. Ben Fuchs and the team are standing by. The show is How to Retire with Ben Fuchs. I'm Gary Nolan, your consumer advocate. Here's that phone number again, 800-380-8985. Do it while you're thinking about it. All right, Diane in Durham. I have close to $1 million in tax-deferred accounts and funds, I should say. I'm 54. Would it be possible to spend down before RMDs kick in, or would conversions to Roth in my early 60s be best?
Diane, this is a great question because the concept of spending down makes sense for a lot of people. The problem is, where's your other money? Because if you spend down this money before you retire, okay, great. Well, where's the rest of your retirement income going to come from? Our goal when we generate income in retirement is to generate interest income that you can take without reducing your principal. So we really don't want to spend down this money. We want to maintain the value of your account. So if we're going to maintain the value of your account, we're going to focus more on Roth conversions as opposed to spending down. How, when, where we do that is completely different based on where you are, how much money you're making, how much money you made when you put these original contributions in, what we project your income and your tax rate to be in retirement. That's something that we do when you come in and sit with us, so we can then figure out what the best action is moving forward. I have had circumstances where I have not wanted people to contribute to a Roth 401k or do Roth conversions. And then I have had circumstances where I want people to max out a 24 or even a 32% tax bracket in retirement so they can then move all that money into the Roth so that it won't be taxed in the future, because we can do these projections. We can look at a break-even point and say, all right, at this age, 10, 15 years later, whatever it may be, here's the point where you have saved more money by doing these conversions than you have by not doing them. And this is what we look like, and here are the examples, and do with them as you wish. Our goal is to give you the options so that you can do whatever you want with your money. We're never going to say you have to do this. We're going to say here's our recommendation and here's why. We're here to help you do it. But that doesn't mean you have to. It's your money.
Yeah, Diane's really thinking ahead. I mean, she's got 19 years before she has to handle the RMDs, am I right? Like, what is she, 54?
54, yeah. So 19 years would make sense if she had to take it at 73. But because she's so young, she won't have to take her required distributions until 75.
Oh, that's right.
Yeah, not that I like Gary because he tries to catch me here and there on the radio, and I appreciate
No,
that.
that's part of the Secure 2.0 Act, right? It's up to 75 at that point, right?
Yeah. Well, if you're up over 75 at 20, 33, I mean that's where we're at. So yes.
Let's get to Gino in Granby. Is it true that you can retire and live on dividend income? I'm 48 years old and want to see if something is actually doable. What is your opinion? Would this opinion be something that's both usable and reusable and safe? Thanks in advance.
So dividend income is interesting. A lot of people really focused on that. I wouldn't say this year or the year prior, but for the previous maybe 10 years, it was a big deal because interest rates were so low. You really couldn't generate hardly any interest in a CD or a bank. We were happy to get 3% if we could find it, and most of the time it was only 2.5%. And so this idea of being able to generate 4.5% from some of these dividend-paying stocks made a lot of sense to people. Now, here are the benefits. You can generate lots of money in dividends and pay less taxes than if you would generate the equivalent amount in ordinary income. You typically pay less in overall taxes. If you can get all of your income from dividend income, you may be paying significantly less than you would pay from ordinary income. So there are specific benefits to it. The problem is, let's look at General Electric and AT&T, two stocks that are, I would say, pretty well known, that anybody in their 50s or 60s is well aware of. They're both stocks that had about a 4% dividend for a very long time, and both of them, at one point or another, cut their dividend in half from around 4% to around 2%. Now, if I have $1 million in AT&T and I'm counting on this $40,000 a year of income, and all of a sudden they drop it and I'm only getting $20,000, well, my lifestyle didn't change, and now I have half the income. So There are concerns there. Also, keep in mind that these dividend-paying stocks are sending out income because they're no longer reinvesting the same amount of money or as much of the profits into growth within the company. And so I don't think that you're getting as much appreciation from some of these dividend stocks as you would from some of the growth stocks. Now, I could be wrong. I'm sure I'm going to get flooded with emails saying, Ben, here's an example where you're wrong. And possible people, I've never been wrong. But, no, of course I've been wrong. But I think in general, we're going to make more money by looking at what we consider to be growth stocks versus dividend stocks, and we should see if it's actually appropriate. I remember vividly, Gary, there was somebody that I talked to. This was in 2019 before COVID. And he told me, he said, look, Ben, I've got a plan. I'm retired. I'm 47 years old. I'm just going to live off of the capital gains because I'm making money in these stocks, and I'm going to sell them off as they grow, and I'm going to pay less in taxes on it. Okay, great. Until COVID hit and the market went down by 33%. And I hope he didn't panic, but that might throw your game off a little bit. And then we get to 2022, where the S&P 500 goes down by 19%, and the NASDAQ goes down by 33%.
Right.
Again, throws your game off a little bit. And if you need money for that year, then you have to sell while the market is down. And if you had some of the high-flying tech stocks in that portfolio in 2022, those went down way more than everything else. Don't get me wrong, they came back way more in 2023, but if you have to sell parts of your portfolio every year, then you don't take part in those same gains when things recover. That's why it's important to have a plan and to know where your income is coming from in retirement, and why I don't like the idea of people just selling off parts of their mutual funds or their stocks to generate the income. You want to have a plan. Some people use annuities. Fine. Annuities aren't terrible, but if you want to leave money to the next generation, taking money from a guaranteed annuity like a pension isn't typically the option, right? It's not usually the best case scenario for somebody that wants to leave behind that money. There are other things where we can expect to generate about 8% a year after our fees, where you can use the interest to live on and to be comfortable and maintain the principal that you have. So again, what are we trying to accomplish? What's the goal? And what's the best way to do it? And just because you might have a plan, and no disrespect to anybody, sometimes it really helps to get a second opinion on that plan to see what the possible pitfalls may be. That's what we're here to help you with. That's why we have a How to Retire Blueprint. So we can not just look at, which mutual fund went up more than the other mutual fund last year. You can do that yourself. But what types of investments do I need to generate the monthly income that I need? And how do I create that income in the most tax-efficient way possible? And when I'm getting that income, when do I take Social Security? And on top of that, is my money going to go where I want it to when I'm no longer here? Let me put all that together for you. That's why we have a How to Retire Blueprint. That's what we're here for, but we can't do any of that unless you pick up the phone and give us a call.
800-380-8985, 800-380-8985, the How to Retire Blueprint. Comprehensive plan, no cost or no obligation. So what are you waiting for? Folks at Fuchs Financial are standing by. 800-380-8985. Well, the show has flown right on by. I'd like to thank everyone for listening. We hope we found the information helpful, and we look forward to all of you being back next week. We'll have new topics, new questions right here on How to Retire with Ben Fuchs, and I'm going to do my best not to get Ben all riled up next week.
How to raise blood pressure by
How to raise Ben's blood pressure, folks. All right, Ben, thank you so much. Great show. I enjoyed it. We'll talk to you next week.
Same here, Gary. Thank you.
Investment advisory services are offered through Foundations Investment Advisors, LLC, hereafter known as Foundations, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment, opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Any discussions of specific strategies are for informational purposes only and have been provided to help determine whether they may be appropriate for your specific situation. If applicable, the primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. Each individual investor situation is different, and ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Nothing herein constitutes a recommendation that any security, portfolio of securities, or investment strategy is suitable for any person. No legal or tax advice is provided. Please review your retirement, tax, and legacy planning strategies with a legal or tax professional before transacting or implementing any strategy discussed herein. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing insurance company, not guaranteed by any bank or the FDIC. This is not endorsed or affiliated with the Social Social Security Administration, any federal Medicare program, or any U.S. government agency. If applicable, we do not offer every plan available in your area. Any information we provide is limited to those plans we do offer in your area. Please contact Medicare.gov or 1-800-MEDICARE to get information on all of your options. All rights reserved.